Doubling your money. You know, it's kind of the holy grail of investing, isn't it? But let's be honest, most of the time it sounds less like a financial plan and more like wishful thinking. So in this explainer, we're going to cut through all that noise and break down 5 actual, proven strategies that can help you get to that 100% return. You ready? Let's do this.
All right, let's just get right to it. The big question on everyone's mind, is this for real? Can you actually double your money, or is that just something that happens in movies and those sketchy late-night commercials?
The answer is a big, loud yes. But, and this is a huge but, it's not about some secret trick, it's not about a get-rich-quick scheme. Hitting a 100% return is absolutely possible. It just takes the right strategy, the right mindset, and, you guessed it, a little bit of patience.
So here's our roadmap. First, we're going to talk about the mindset, getting our heads in the right space. Then, we'll uncover what might be the closest thing you'll ever find to a guaranteed 100% return. After that, we'll dive into 2 very different investing styles, take a look at the high-stakes, high-reward stuff, and then wrap it all up with a super simple formula you can use to figure out your own timeline.
Okay, before we even whisper the name of a single stock or fund, we got to start with the absolute foundation. And that's you. Seriously. The most powerful tool in your entire investing toolkit isn't an app, it's your own disciplined mind.
Look, you wouldn't want to find out you're afraid of heights while you're already jumping out of a plane, right? Well, it's the same with investing. You have to be brutally honest with yourself about how much risk you can stomach before things get rocky. You cannot let greed and fear grab the steering wheel. And if anyone, I mean anyone, offers you a guaranteed way to get rich quick, just turn and run. The real path to success is kind of boring, but it works. Diversification and patience.
All right, now that we've got the ground rules down, let's get into our first real strategy. And this one, well, our source material calls this the undisputed heavyweight champ of doubling your money.
So where on earth do you find an instant 100% return? Probably at your job. I'm talking about your 401k employer match. If your company matches your contributions dollar for dollar, every single dollar you put in is immediately doubled. That's a 100% return before that money has even had a chance to be invested. You will not find a better deal anywhere else, period.
And just listen to financial advisor Peter Lazaroff here. He says securing that match is crucial. Think about it this way. It's not a perk, it's part of your salary. Turning down the full match is literally like leaving a chunk of your paycheck on the table for your boss to keep. It's the first, most important thing you should do.
So once you've scooped up all that free money from your employer match, what's next? Well, now it's time to build the rest of your portfolio. And when you do, you'll find there are basically 2 major philosophies. The classic steady-as-she-goes route and the more daring swim against the current contrarian play. The classic, time-tested approach is something called the 60-40 portfolio. It's simple. 60% of your money goes into stocks, think something broad like an S&P 500 index fund, and the other 40% goes into safer investment-grade bonds. It's not going to make you a millionaire overnight, but historically, this mix has averaged a return of about 8.6% a year. It's a reliable workhorse. And then, there's the other side, the contrarian view. It's perfectly captured by this legendary, if a little intense, quote from Baron Rothschild. The whole idea is to do the exact opposite of what everyone else is doing. When the market is panicking and there's fear everywhere, that's when the contrarian goes shopping for bargains. So let's break it down. Classic investing is like sailing a really sturdy, well-built ship across the ocean. It's designed to handle the waves. Contrarian investing, that's more like being a storm chaser. You're intentionally steering into the hurricane because you believe there's a huge reward waiting in the eye of the storm. Both can work, but man, they require totally different personalities. Okay, so if that 60-40 portfolio is the safe, steady, right lane on the investment highway, what we're about to talk about now, this is the fast lane. Yeah, you might get where you're going a lot faster, but the chance of a spectacular crash is way, way higher. We're talking about things like stock options, crypto, trading on margin, penny stocks, the whole shebang. Can these things juice your returns? Oh yeah, absolutely. But, and you knew there was a but, they can also vaporize your nest egg in a heartbeat. It's like financial fireworks. Really exciting, but incredibly dangerous. So please, only play with money you are 100% okay with losing. And if you want to know why people get so tempted, just look at this number. That's the 10-year annualized return for Bitcoin. I mean, wow.
That potential for explosive, life-changing growth is the siren song that pulls so many people into these riskier assets.
But then there's this. This is what happened to Bitcoin in just one single year, a drop of more than 72%. This is what extreme volatility looks like. The same rocket that can send your portfolio to the moon could also turn around and send it straight into the ground.
And it's not just the crazy price swings you have to worry about. The crypto space in particular can be an absolute minefield. A 2024 report from FINRA, that's the Financial Industry Regulatory Authority, found that a staggering 70% of crypto ads they looked at were unclear, misleading, or just flat out false. So the risk isn't just that you'll make a bad bet, it's that you could get tricked into one.
Phew, okay. We have covered a lot, from the safest moves to the absolute riskiest. So now, let's bring it all home with a simple, really powerful tool that you can use to map out your own financial journey. It's called the Rule of 72.
The Rule of 72 is one of my favorite mental shortcuts in all of finance. It's so easy. You just take the number 72, divide it by whatever annual return you expect to get, and boom, that number is roughly how many years it'll take for your money to double.
And this is where the magic happens. Look at this chart. If you're getting a 7% return, your money doubles in about 10 years. Get that up to 9% and your timeline shrinks to just 8 years. And hey, where have we seen a number like that before? That's right in the ballpark of that classic 60-40 portfolio we talked about. All of a sudden, these abstract percentages start to feel like a real tangible plan.
So how do we put this all together into your own master plan? It's really just 4 steps. Step 1, and this is totally non-negotiable, get that free money from your 401k match. Step 2, build a solid foundation with a diversified portfolio. Step 3, and only after you've done the first 2, decide if you want to add a little spice with a small, calculated bet you can afford to lose. And finally, step 4, make sure this whole plan actually matches your personal goals and your timeline.
And I want to leave you with one last really important question to ask yourself. As you go out there trying to double your money, always keep this in the back of your mind. In any given investment, is someone using you to double their money? Be smart, be skeptical, and make sure that at the end of the day, you're the one in control of your financial destiny.